It didn't start with a bang. It didn't start with a breaking news alert on Bloomberg. It didn't start with a chaotic shout on the floor of the New York Stock Exchange. It started with silence. Friday, January 23rd, 2026, 8 o'clock in the morning. While most of the market was still easing back from the pre-market coffee, something unusual showed up on the Comex silver screens. Not volatility, not panic, just an absence. For 12 minutes, the bid and the ask didn't blink. It was the kind of low-grade static silence that makes veteran traders sweat because we know exactly what it means. It means the algorithm has lost the scent. It means the machine no longer knows what the price is. And then, without warning, a rupture. The silver screens didn't grind higher. They didn't stair-step. They broke. The price teleported vertically, shattering technical resistance levels that had held for a decade in a matter of seconds. I have been analyzing physical metals markets and stacking silver for 12 years, and what I was watching a few hours before I hit record does not fit any normal price pattern. It wasn't a rally, it was a structural failure. Within minutes of the open, the major bullion dealers, APMEX, JM Bullion, the whales of the retail market, went dark. Simultaneous out-of-stock notices plastered across huge swaths of their silver inventory. Not a slow bleed, not a lunchtime rush, a vacuum. And while the financial media was preaching calm, reporting benign outlooks for commodities, the head of Goldman Sachs metals desk quietly exited the building, leaving his terminal logged off and his position vacant. This is not a speculative bubble. This is not Reddit traders having fun. This is the day the paper market finally slammed into the concrete wall of physical reality. The Western price discovery mechanism has been bypassed. The vaults are bleeding, and the arbitrage trap has snapped shut. This is veiled wealth. And today, I'm going to walk you through the exact mechanics of the silver market collapse, why the $13 gap between New York and Shanghai is a death sentence for the dollar, and exactly how you need to position yourself before the trading halt becomes permanent. Let's reconstruct the crime scene. Because to understand where we are going, you have to understand the specific sequence of failures that happened this morning. At 8:05 a.m. EST, silver futures on the Comex were trading at a nominal price. At 8:17 a.m. EST, a massive block order hit the Shanghai Gold Exchange. Normally, arbitrage bots, automated programs designed to keep prices equal across global exchanges, would instantly sell in Shanghai and buy in New York to close the gap. But today, the bots didn't fire. Why? Because the bots know something the public doesn't. They know that you cannot arbitrage a price difference if you cannot source the physical metal to settle the trade. By 9:00 a.m., the spread between the New York price and the Shanghai price had blown out to $13.55 per ounce. Let me repeat that. $13.55. In a market where traders fight over fractions of a penny, a $13 spread is not an inefficiency. It is a ruptured aorta. It means that silver in China is worth 12% more than silver in America, and yet nobody is shipping silver from America to China to capture the profit. Why? Because there is no silver left in America to ship. And the most dangerous part of this move isn't the price, it's the personnel. When I pulled the morning data officially, Benjamin Bennett Lane, the head of Goldman's metals desk, was no longer listed on the active trader roster. When the smartest guys in the room, the ones with the best algorithms, the deepest leverage, and the most inside information, quit on a Monday morning during the biggest move in their market in years, it's not because they're tired. It's because they've seen the internal numbers. They've run the stress tests. They know the math no longer adds up. Goldman doesn't lose their top metals trader on the same day silver goes parabolic by coincidence. They lose him because he knows what's coming, and he wants to be as far away from the blast radius as possible when the exchange runs out of metal to deliver. Most analysts are completely ignoring the mechanism driving this. They are looking at charts. They are looking at RSI. They are looking at moving averages. Forget the charts. The charts are a map of the past. The arbitrage trap is the engine of the future. Think of it like this. Imagine there are two stores in your town that sell bread. Store A is the Comex in New York. They sell a loaf for $1. Store B is the Shanghai Gold Exchange. They are willing to buy that same loaf for $5. What happens? It is basic human nature. People will buy every single loaf from Store A until the shelves are completely empty. They will load trucks. They will hire mules. They will carry it by hand if they have to. Then they immediately walk it over to Store B and sell it for 5 times what they paid. This continues until Store A has no bread left. At that point, the $1 price at Store A becomes meaningless. It is a ghost price. It is a number painted on the window of an empty store. You can walk in and slap $1 on the counter, but the clerk will just shrug. No bread. That is exactly what is happening right now between New York and Shanghai. The Comex cannot just instantly raise their price to match Shanghai. They are locked into futures contracts. They have promised to sell silver at yesterday's prices for the next 30 days. They are bound by the rules of the system they created. This delay, this structural lag, allows store B, China, to systematically drain every loaf, every ounce of silver at a massive discount until store A, the West, literally runs out of inventory. That spread, 13.55, is a vacuum. It is sucking the physical wealth of the West into the vaults of the East. And once the metal is gone, it doesn't come back. Silver is not digital code. You cannot fork a silver bar. Once it crosses the ocean to Shanghai, it disappears into the black hole of Chinese strategic reserves. Now, let's look at the bread store's inventory. Because the skeptics will tell you, the Comex has plenty of silver. They can settle in cash. They can change the rules. Let's run the math. As of this morning, the Comex registered. Inventory, that is the category of silver that is actually available to be delivered against a contract, was sitting at roughly 30 million ounces. That sounds like a lot, 30 million ounces, but let's put that number in context. 30 million ounces is roughly $900 million at current prices. In the world of global finance, $900 million is a rounding error. Elon Musk could buy the entire registered inventory of the Comex with the cash he finds in his couch cushions. A single mid-sized hedge fund could wipe it out in an afternoon. But here is the stress test scenario. According to the open interest data I reviewed, there are 46 million ounces standing for delivery in the January contract month alone. Do the math. Demand, 46 million ounces. Supply, 30 million ounces. Deficit, 16 million ounces. How do you fill a 16 million ounce hole? You can't. You can try to convince holders of eligible silver, silver stored in the vault but not for sale, to sell. But why would they sell now? They see the same arbitrage gap. They see the price in Shanghai. They know the price is going higher. If you own silver in a Comex vault, are you going to sell it to the exchange for $28 so they can cover their shorts? Or are you going to hold it and wait for $50? Or ship it to Shanghai and sell it for $45 immediately? The eligible holders are not riding to the rescue. They are tightening their grip. So the exchange has three options. Option 1, default on delivery. Admit they don't have the metal. This destroys the exchange's credibility instantly. Option 2, force, cash settlement. Tell the buyers, sorry, no metal. Here's a check for the dollar value. This is a soft default. It saves the system, but destroys the price mechanism. Option 3, change the rules, raise margins, limit position sizes, make it illegal to buy. We are seeing signs of option 3 already. Rumors of a 100% margin hike by the CME are circulating. This is designed to force leveraged traders to sell. It is a desperate attempt to lower the price on paper to stop the bleeding. But in 2011, when they did this, there was no Shanghai arbitrage. Today, if they smash the paper price, they just make the bread at store A even cheaper. They accelerate the drain. They are pouring gasoline on the fire. There is another layer to this disaster that nobody is talking about: the supply chain fragility. Let's assume for a moment that there is plenty of silver in the ground. Let's assume the miners can just dig faster. It doesn't matter. Why? Because raw ore is not a delivery bar. To settle a Comex contract, you need a 1,000 ounce bar that meets good delivery standards. It must be 99.9% pure. It must be stamped by an accredited refiner. It must have a paper trail. There are only a handful of refineries in the world accredited to produce these bars. I was reviewing refinery data earlier this week. The wait times for new production have stretched from the typical 4 weeks out to 12 weeks or longer. That is a 3-month lag. If the Comex runs out of metal next week, they cannot get new bars until April. You cannot refill a leaking bucket if the water source is 12 weeks away and the leak is happening in real time. And the logistics? Moving millions of ounces of silver isn't like moving Bitcoin. It is heavy. It requires armored trucks. It requires secure air freight. Insurance premiums for shipping precious metals have spiked 300% in the last month because insurers are terrified of theft or seizure. We are seeing a physical seizure of the logistics network. The metal is stuck. The refineries are choked. The vaults are empty. The paper price is a fiction. Who is doing this? Who is the store bee buying all the bread? It's not just retail investors. It's not just hedge funds. The footprint suggests a sovereign actor, China. China has been systematically accumulating commodities for a decade. They have stockpiled oil. They have stockpiled copper. They have stockpiled gold. And now the data suggests they are cornering silver. Why? Because silver is the Achilles heel of the Western high-tech war machine. You cannot build a Tomahawk missile without silver. You cannot build a solar panel without silver. You cannot build an EV without silver. You cannot build a sophisticated semiconductor without silver. Silver is a strategic industrial metal masquerading as a monetary metal. If China drains the West of silver, they don't just make a profit. They cripple Western industrial capacity. They force U.S. defense contractors to buy silver from Shanghai at a premium. It is economic warfare disguised as market dynamics. The $13 spread is not an accident. It is a weapon. And the silence from the White House regarding this strategic depletion tells you everything you need to know. They were caught sleeping. Now, look at what is happening on the streets. In Japan, a G7 economy, a modern financial hub, we are seeing lines stretching for 5 hours outside bullion dealers in Ginza. Tanaka Kikenzoku suspended silver sales today. Think about that. A store that exists to sell silver stopped selling silver because they ran out. This is the psychology shift. For decades, silver bugs were mocked, called doomers, called tinfoil hatters. But here's the thing about being early. Eventually, you are right. And when you are finally proven right after years of being dismissed, the public psychology shifts instantly from mockery to FOMO, fear of missing out. People who ignored silver at 25s are now panicking to buy it at 113. But here is the problem with retail FOMO in a physical market. You cannot print more silver to satisfy the demand. When retail panic hits a stock, the market makers just issue more shares or create more liquidity. When retail panic hits silver, the out-of-stock sign goes up. And that is when the price goes vertical. We are moving into a phase where the spot price might be $120, but the actual price to get a bar in your hand is $160. The premium becomes the real price. The screen price becomes a relic. If the Comex defaults, it doesn't just stay in the silver market. The contagion spreads. There are trillions of dollars in derivative contracts tied to commodities. Interest rate swaps use commodities as collateral. ETFs promise physical backing, but hold futures. If you can't trust a Comex silver contract, why would you trust a gold contract? Why would you trust an oil contract? The entire derivatives edifice relies on the assumption that delivery is possible, but nobody will ask for it. Today, somebody asked for it. And the answer was, we don't have it. This undermines the collateral chains of the global banking system. Banks borrow overnight using these assets as collateral. If the collateral is deemed unreliable, the repo market freezes. We saw this in 2008 with mortgage-backed securities. We could be seeing it in 2026 with commodity-backed derivatives. So where does that leave you? If you are watching this, you probably sense that the rules have changed. Here is my personal plan. This is what I am doing with my own capital. This is not financial advice. This is transparency in the face of a collapsing system. Protocol 1. Physical possession is non-negotiable. Do you have your metal in your hand, or is it a line item on an app? If it is in an app, get it out. Now, the unallocated accounts, where you own a share of a pool of silver, are the first to be defaulted on. When the music stops, there are 100 claims for every one bar. Only the person holding the bar owns it. Everyone else owns a lawsuit. Take delivery, pay the shipping, get it in your safe. Protocol 2, watch the ratio, not the price. Don't get fixated on the dollar price. The dollar is dying. Watch the gold to silver ratio. It is currently compressing. Watch the Shanghai to New York spread. If that spread hits $25, I am treating Comex as a failed entity. I will stop looking at the spot price entirely. I will value my holdings based on the street price, the eBay price, the Shanghai price. The spot price is about to become the fake price. Protocol 3, the dip is a trap or a gift. Expect the empire to strike back. They will raise margins. They will try to smash the price down one last time to shake you out. If silver drops to $100 on a margin hike, do not panic. Recognize it for what it is, a paper tantrum in a physical crisis. If they smash the price, I am buying more physical. Because a lower price just accelerates the drain. It makes the arbitrage even more profitable. They are trapping themselves. Don't let them trap you. Protocol 4, zero liability. Silver is insurance. It is the only financial asset that is not simultaneously someone else's liability. Stocks are a liability of the corporation. Bonds are a liability of the government. Bank deposits are a liability of the bank. Silver is just silver. In a world of defaulting liabilities, you want assets that stand alone. The floor went quiet this morning for a reason. The silence before the break is always louder than the noise that follows. The arbitrage gap is real. The vault depletion is real. The institutional exits are real. Benjamin Ben Lane didn't leave Goldman Sachs because he wanted to spend more time with his family. He left because he saw the avalanche coming. We are witnessing the end of the 50-year experiment in paper-manipulated commodity pricing. We are returning to a world where value is determined by scarcity, utility, and physical possession. The paper game is over. The physical game has begun. You can chase the price. You can wait for a correction. Or you can ignore the whole thing and hope your dollars hold their value. But you cannot say you weren't warned. This is veiled wealth. We uncover what the system hides. The rupture has happened. Prepare accordingly.